What if I told you that China's recent $53 billion Treasury sell-off is not just economic housekeeping, it's a historical replay of the exact financial weapon that demolished the British Empire in 1931? And what if the same mechanism that turned Britain from global superpower to economic dependent is now being deployed against the United States? Except this time the stakes are nuclear-level catastrophic. You're watching your grocery bills climb. Your rent just jumped again. Your savings account earns nothing while inflation eats 7% of your purchasing power annually. The news tells you it's supply chains, it's corporate greed, it's pandemic hangover. They're lying. What you're experiencing right now is the financial equivalent of continental plates shifting beneath your feet. And China's treasury dump? That's not the earthquake. That's the seismograph warning that the big one is coming. Let me be brutally clear. When a foreign power holding $3 trillion in reserves starts systematically liquidating your government as debt, they're not diversifying their portfolio. They're testing the structural integrity of your entire monetary system. They're probing for cracks. And when they find them, and they will, the collapse won't be gradual. It'll be vertical. Britain learned this lesson the hard way in 1931. The world's most powerful empire, controlling a quarter of the globe's landmass and population, was brought to its knees not by armies or revolutions, but by a coordinated financial assault that exploited one fatal flaw. Their entire system was built on borrowed confidence. Sound familiar? Because right now, the United States is running the exact same playbook Britain ran in the 1920s. Massive debt, overextended military commitments, a reserve currency propped up not by gold or productive capacity, but by the collective faith that everyone will keep playing along. And China just stopped playing along. Before we go deeper, I need to know something. Drop a comment right now and tell me where you're watching from. Are you in the US watching your currency's dominance slip away? Are you in Asia watching the power shift happen in real time? Or are you somewhere else entirely, watching two empires play financial chicken with your economic future? And if you're new here, hit that subscribe button right now. This channel doesn't do clickbait conspiracy theories. We do pattern recognition. We connect historical dots that textbooks deliberately leave scattered. Because the uncomfortable truth is this: financial empires don't collapse by accident. They are dismantled piece by those who understand that modern warfare is not fought with missiles, it's fought with balance sheets. Now let me show you the receipt. In the next 20 minutes, I'm going to walk you through the most dangerous financial mechanism in modern history. You're going to see how Britain's 1931 collapse was engineered using the exact same strategy China is deploying right now. You're going to learn why Treasury sell-offs are the financial equivalent of pulling support beams from a skyscraper. And you're going to understand why this time, when the system breaks, there's no backup empire to bail us out. Because in 1931, Britain had America. In 2025, America has nobody. Let's begin. In 1925, Winston Churchill made what economists now call one of the worst financial decisions of the 20th century. As Chancellor of the Exchequer, he returned Britain to the gold standard at the pre-World War I exchange rate of 4.86 per pound. On paper, this looked like strength. In reality, it was economic suicide. Here's why. World War I had fundamentally transformed the global economy. Britain had borrowed massively to finance the war. Its industrial base was damaged. Its workforce was depleted. Meanwhile, the United States emerged as the world's largest creditor nation and industrial powerhouse. But Churchill wanted to restore Britain's prestige. He wanted the pound to symbolize strength and stability. So he overvalued the currency by approximately 10 to 15% against economic reality. Sound familiar? Because right now, the US dollar is overvalued by nearly every fundamental metric. The dollar index sits artificially elevated, not because of American productivity or fiscal discipline, but because it's the world's reserve currency. It's valuable because everyone agrees it's valuable, a collective hallucination maintained by military power and institutional inertia. Britain's overvalued pound created an immediate crisis. British exports became uncompetitive. Coal, textiles, steel, the backbone of British industry, couldn't compete with cheaper American and European goods. Unemployment soared. Wages were cut. Labor strikes paralyzed the economy. But here's where it gets sinister. The British government knew this would happen. Treasury advisors explicitly warned Churchill that returning to gold at pre-war parity would devastate the working class. Economist John Maynard Keynes published a pamphlet titled The Economic Consequences of Mr. Churchill, predicting exactly this outcome. Churchill did it anyway. Why? Because maintaining the pound's prestige was more important than the suffering of ordinary British citizens. The empire's credibility on the world stage, its ability to continue borrowing, its status as the financial center of global trade, all of this depended on the illusion of monetary strength. Sound familiar? The Federal Reserve right now is doing the exact same thing. Interest rates have been weaponized not to control inflation, but to maintain dollar dominance. Every rate hike makes dollar-denominated debt more expensive for foreign nations. Every rate hike strengthens the dollar artificially, making American exports less competitive, but making it more expensive for countries to dump treasuries. It's financial coercion disguised as monetary policy. For 6 years, Britain maintained the charade. The pound stayed overvalued. The economy struggled. But the empire's creditors, mostly France and the United States, kept the system afloat because they had massive sterling holdings they didn't want to see devalued. Then came 1931. In May, Austria's largest bank, Creditanstalt, collapsed. This triggered a banking panic across Europe. Depositors rushed to convert their currency holdings into gold. The contagion spread to Germany, then to Britain. By September 1931, the Bank of England faced a crisis. Foreign creditors were demanding gold in exchange for pounds. Britain's gold reserves were hemorrhaging. The bank tried to borrow from France and the U.S. Federal Reserve, but the emergency loans weren't enough. On September 24, 1931, Britain abandoned the gold standard. The pound's value collapsed overnight, falling 25% within weeks. The world's reserve currency, the bedrock of global finance for over a century, became just another piece of paper backed by nothing but hope. Here's the number that should terrify you. When Britain abandoned gold, over 40 countries followed within months. The entire global monetary system, built on sterling dominance, disintegrated in less than a year. Sound familiar? Because China's treasury dump isn't happening in isolation. Since 2022, we've seen China reducing U.S. Treasury holdings from $1.3 trillion to under $800 billion, Japan quietly diversifying reserves, BRICS nations developing alternative payment systems, Saudi Arabia accepting yuan for oil transactions, and central banks globally buying gold at record 50-year highs. This is coordinated de-dollarization. This is the 1931 sterling crisis in slow motion. Here's what most people don't understand about reserve currencies. There are confidence games that require perpetual growth of both trust and liquidity. Britain's sterling system worked because the world needed pounds to conduct trade. This created automatic demand for British government debt. Britain could borrow cheaply, run deficits, and export inflation to its trading partners. The empire didn't have to balance its books because everyone else was forced to hold sterling reserves. But this privilege creates a fatal dependency. The reserve currency nation must run persistent trade deficits to supply the world with enough currency to function. You have to export more money than you import goods. This is called the Triffin dilemma, and it's economically terminal. For Britain in the 1920s, this meant borrowing to maintain imperial commitments while domestic industry collapsed. For America today, this means running $1+ trillion annual trade deficits, printing dollars to finance government spending, and watching manufacturing hollow out, all while pretending it's sustainable because the world needs dollars, until they don't. When creditors lose faith in a reserve currency, they don't gradually diversify. They panic. They dump. They trigger the very collapse they feared, creating a self-fulfilling prophecy. In 1931, it was France and American institutions demanding gold. In 2025, it's China liquidating treasuries and BRICS building alternative systems. Sound familiar? The pattern is identical. The mechanism is identical. The outcome will be identical. Only this time, the scale is planetary. Now here's where the story gets absolutely wild. Because buried in the Bank of England archives is a document that most financial historians gloss over. It's a series of internal memos from July 1931, 2 months before Britain abandoned gold, that reveal the British government knew exactly what was coming. They had the data. They saw the gold reserves declining. They tracked the French sell-offs. They knew the system was unsustainable. And they did nothing. Why? Because admitting weakness would trigger the very panic they were trying to avoid. So they maintained the illusion of stability while quietly preparing for collapse. Senior officials moved personal assets into hard assets: land, gold, foreign currencies. Meanwhile, ordinary British citizens kept their savings in pounds, trusting their government right up until the day those pounds lost a quarter of their value overnight. This is what I call collapse theater, the performance of confidence by those who know the truth while the public is kept deliberately ignorant until it's too late to protect themselves. And we're watching the exact same play right now. The Federal Reserve's balance sheet has expanded from $800 billion in 2008 to over $7 trillion today. That's not economic management. That's monetary heroin. The Fed is trapped. They can't reduce the balance sheet without triggering market collapse, but they can't keep expanding it without destroying the dollar's purchasing power. Jerome Powell knows this. Treasury Secretary Yellen knows this. Every major central banker on earth knows this. Just like Britain in 1931, they're maintaining the illusion while positioning themselves for the collapse. But here's the twist that's going to blow your mind. China isn't just dumping treasuries randomly. They're doing it surgically. Look at the timing. Major sell-offs coincide with Federal Reserve policy announcements. Liquidations accelerate during Treasury auction windows, and the pace increases precisely when the U.S. needs foreign buyers most. This isn't panic selling. This is strategic economic warfare. China watched what happened to Russia when Western nations froze $300 billion in Russian reserves after the Ukraine invasion. They learned the lesson. Dollar reserves aren't assets. They're hostages. They're leverage your enemy holds over you. So China is executing a controlled exit, not fast enough to trigger immediate crisis. That would crash their own remaining holdings, but steady enough to signal to other nations, the dollar system is ending and you need to prepare. Now here's where the Britain parallel becomes chilling. In 1931, Britain didn't just lose reserve currency status. They lost the ability to borrow cheaply as interest rates spiked, global trade dominance as the sterling bloc dissolved, military projection capability as the empire began contracting immediately, domestic living standards as a decade of austerity followed, and political stability as the government collapsed within months. The empire survived, but it was mortally wounded. Britain spent the next 15 years slowly bleeding out until World War II delivered the final blow. When reserve currency status evaporates, it doesn't just hurt your economy, it ends your empire. And here's the truly terrifying part. Britain had a successor. The United States was ready and willing to assume global financial leadership. The system had a backup plan. Today, there is no heir apparent. China's yuan isn't ready. Europe's euro is structurally flawed. No single currency can replace the dollar, which means when the dollar loses reserve status, we're not getting a smooth transition to dollar 2.0. We're getting monetary chaos on a scale never seen in human history. Still think China's $53 billion Treasury dump is just portfolio rebalancing? Because I haven't even told you the most disturbing part yet. You see, there's a name attached to China's de-dollarization strategy. A specific individual inside the People's Bank of China who studied the 1931 sterling crisis extensively and wrote internal policy papers explicitly recommending the British exit model as the optimal strategy for dismantling reserve currency dominance. You won't believe the name, and the receipt is wilder than you think. Because this person did not just study how Britain fell. They studied how the US and France orchestrated that fall. They reverse engineered the entire playbook. They identified the specific pressure points that turn a reserve currency into toilet paper overnight. And now they're executing that plan against America with mathematical precision. Let's start with a number that should terrify you. $31 trillion. That's the current size of the US Treasury market, the total outstanding debt of the United States government. It's the largest, most liquid bond market in human history. It's the foundation of the global financial system. Pension funds, insurance companies, foreign governments, banks, everyone holds treasuries because they're considered the risk-free asset. Except they're not risk-free, they're faith-based. Here's how the illusion works. U.S. treasuries are valuable because everyone believes the U.S. government will always pay its debts. This belief rests on three assumptions. First, the U.S. can always print dollars to pay dollar-denominated debt. Second, the dollar will remain the global reserve currency. Third, foreign creditors will continue buying treasuries to maintain the system. When all three assumptions hold, the system appears unbreakable. The U.S. can borrow essentially unlimited amounts at relatively low interest rates. This is called exorbitant privilege. But watch what happens when even one assumption cracks. If foreign creditors stop buying treasuries, the Federal Reserve must buy them instead through quantitative easing. This means printing money, which dilutes the dollar's value, which makes foreign creditors want to hold fewer dollars, which forces more Fed purchasing, which prints more money. It's a death spiral disguised as monetary policy. Britain discovered this in 1931 when France, holding massive sterling reserves, started converting pounds to gold. The Bank of England had two choices: defend the currency by raising interest rates and crushing the domestic economy, or let the currency collapse. They tried option one. It failed. Then option two happened anyway. Sound familiar? The Federal Reserve is facing the exact same impossible choice right now. Keep rates high to defend the dollar, killing the housing market, corporate debt refinancing, and triggering unemployment, or cut rates, accelerating inflation, and dollar devaluation. There is no good option. The math does not work. Now let us talk about how China is exploiting this structural weakness with surgical precision. When China sells $53 billion in treasuries, they are not just reducing their holdings. They are executing a multi-layered attack on system liquidity and confidence. The first layer is direct price pressure. When any large holder dumps bonds, prices fall and yields rise. Bond prices and yields move inversely, so higher yields mean higher borrowing costs for the U.S. government. Right now, with $31 trillion in debt, every 1% increase in average interest rates costs an additional $310 billion annually in interest payments. China's sell-offs push yields higher. Higher yields mean the U.S. deficit explodes even faster. Faster deficits mean more borrowing. More borrowing means more supply. More supply means even higher yields. It is a compounding nightmare. The second layer involves auction dynamics. The U.S. Treasury auctions new debt constantly, roughly $8 to $10 trillion per year in gross issuance. These auctions rely on consistent foreign demand. When major holders like China exit, someone must fill the gap. Typically, that someone is the Federal Reserve printing money, domestic banks using depositor funds, or hedge funds using leverage. None of these are sustainable. The Fed cannot print forever without destroying currency value. Banks cannot keep buying low-yield treasuries when depositors demand higher returns elsewhere. Hedge funds are fragile. When treasury prices fall, leveraged positions get liquidated, accelerating the crash. In 1931, British government bonds experienced this exact spiral. As foreign holders exited, domestic institutions were forced to absorb more debt. When those institutions became overexposed, they started failing. That triggered bank runs, that forced gold redemptions, that collapsed the currency. The third layer is psychological signaling, and this is the most dangerous. When China, a rational and calculating actor, liquidates treasuries, they are sending a message to every other foreign holder. We see something you do not, and we are getting out. This is how confidence evaporates. Japan holds $1.1 trillion in treasuries. If they conclude China knows something they do not, they will start diversifying. Gulf states hold hundreds of billions. European central banks hold trillions. Once the exodus begins, it becomes a stampede. Remember that 40 countries abandoned the gold standard within months of Britain-IS collapse in 1931. Not because their individual economies required it, but because confidence is contagious in both directions. Now here is a mechanism most people do not even know exists, but it is the actual detonator for this entire system. The Federal Reserve's reverse repurchase facility currently holds around $500 billion, down from $2.5 trillion in 2023. This is where money market funds and banks park cash overnight, earning a risk-free return directly from the Fed. Here's why this matters. When Treasury yields were near zero, trillions in cash fled into the RRP facility because it offered better returns than actual treasuries. Now that the Fed has raised rates, that cash is slowly flowing out of the RRP and into higher yielding investments. That sounds good, but it is not. When cash leaves the RRP, it creates liquidity pressure in funding markets. Banks need that overnight cash to function. When it disappears into longer-term investments, short-term borrowing rates spike. This is called a liquidity crunch. In September 2019, overnight repo rates spiked from 2% to 10% in a single day because of a relatively minor liquidity shortage. The Fed had to intervene with emergency funding. That was a $500 billion problem. We are now dealing with a multi-trillion-dollar problem. If China's treasury liquidations coincide with RRP drainage and reduced foreign demand at treasury auctions, you get a liquidity event that makes 2008 look like a practice run. In 1931, Britain's liquidity crisis unfolded over months. Today, with high-frequency trading, algorithmic selling, and interconnected global markets, the same crisis would unfold in hours. Here is where the true systemic risk lives, the shadow banking system. Hedge funds, money market funds, and non-bank financial institutions hold roughly $63 trillion in assets globally, nearly double the size of the traditional banking system. Much of this is built on treasury collateral. Here is the mechanism. A hedge fund borrows $100 million using $10 million in treasuries as collateral. They use that $100 million to buy more treasuries. They then use those treasuries as collateral to borrow $1 billion. This process repeats. This is called repo leverage. And it creates artificial demand for treasuries while masking the system's fragility. When treasury prices fall because China is selling, the value of collateral falls. When collateral value falls, lenders issue margin calls, demanding either more collateral or immediate repayment. But if everyone is leveraged using the same collateral, there is no reserve cushion. Margin calls force asset sales. Asset sales drop prices further. Lower prices trigger more margin calls. This is exactly what destroyed long-term capital management in 1998. Lehman Brothers in 2008, and Archegos Capital in 2021. Except now, the collateral at risk is not corporate bonds or mortgage securities. It is U.S. Treasuries, the so-called risk-free foundation of the entire system. In 1931, this leverage existed primarily in British banks, holding sterling assets. When the pound collapsed, those banks failed. But the damage was contained within the British financial system and its direct trade partners. Today, Treasury exposure is planetary. Japanese pension funds, European insurance companies, Middle Eastern sovereign wealth funds, and Chinese state banks are all holding the same collateral. When it fails, there is no firewall. Now let us talk about what China is doing with the proceeds from treasury sales. They are not converting into other Western currencies. They are not buying European bonds. They are building an alternative financial architecture designed to survive a dollar collapse. First is gold accumulation. China has increased its gold reserves from 1,054 tons in 2015 to over 2,300 tons officially, and likely more than 4,000 tons unofficially. This provides a hard asset foundation independent of dollar confidence. Second are bilateral currency swaps. China has established currency swap lines with more than 40 countries, allowing direct yuan to local currency trade without dollar intermediation. This is the financial equivalent of building roads that bypass the United States entirely. Third is the CIPS payment system. The cross-border interbank payment system processes yuan transactions outside the SWIFT network, which the United States controls. Russia, Iran, and dozens of other nations now use CIPS for sanctions-resistant trade. Fourth is commodity backing. China is stockpiling physical commodities such as oil, natural gas, agricultural products, and industrial metals. When currency confidence fails, physical goods become the ultimate store of value. This is the 1931 playbook inverted. Britain's mistake was believing the sterling system was irreplaceable. They thought the world needed London's financial infrastructure too much to abandon it. They were wrong. The world adapted within months. New trade relationships formed. Alternative reserve assets emerged. The British Empire's financial dominance evaporated, not because the pound became worthless overnight, but because everyone realized they could function without it. China learned this lesson. They are not attacking the dollar to destroy it. They are simply demonstrating that alternatives exist. And once enough nations see the exits, the stampede becomes inevitable. We need to talk about the true doomsday mechanism, the derivatives market. The global derivatives market is estimated at $600 to $700 trillion in notional value, roughly 7 times global GDP. The largest category is interest rate derivatives. These are financial instruments that allow institutions to hedge interest rate risk. Banks, pension funds, and corporations use them to protect against rate changes. But here is the toxic part. These derivatives are built on the assumption that treasuries remain stable. When treasury prices become volatile, as they are now with China selling, the value of interest rate derivatives swings wildly. This creates collateral disputes between counterparties, meaning disagreements over who owes whom money. In 2008, these disputes froze credit markets. Banks stopped lending to each other because nobody knew who was solvent. The system seized up completely. Now imagine that scenario, but instead of mortgage-backed securities as the disputed collateral, it is U.S. Treasuries. There's no bailout big enough. There's no central bank intervention powerful enough. In 1931, the derivatives market barely existed. Britain's collapse destroyed banks and governments, but the contagion was somewhat containable. Today, the interconnection is absolute. A treasury market seizure would trigger pension fund insolvency because they are massively long treasuries, bank failures because treasuries are tier 1 capital, money market funds breaking the buck and freezing redemptions, corporate credit market collapse as companies cannot roll over debt, and sovereign debt crises as foreign governments hold trillions of dollars in treasuries as reserves. This is not a recession. It is not even a depression. It is a monetary extinction event. Here is the final crucial difference between 1931 and today. Britain's collapse took years to fully unfold. Gold outflows began in 1929. The crisis peaked in 1931. The economic depression lasted through the 1930s. The system had time to adjust. Alternative arrangements could be negotiated. Physical gold could be transported. Diplomatic solutions could be attempted. Today, $53 billion can move in milliseconds. Algorithmic trading can liquidate entire positions before humans even realize what is happening. High-frequency trading can turn a sell-off into a flash crash in seconds. The 1931 timeline was measured in months. The 2025 timeline will be measured in days, maybe hours. When treasury market confidence breaks, you will not have time to move assets. You will not have time to protect savings. By the time mainstream media reports the crisis, it will already be over. This is why China's strategic liquidation is so brilliant and so terrifying. They are not triggering the collapse. They are positioning themselves to survive it. They are exiting slowly enough to extract value, but visibly enough that observant nations can see the writing on the wall. Britain in 1931 believed until the very end that confidence would hold. It did not. America in 2025 is believing the exact same lie, and China is counting on it. So let me paint you the picture of what happens when reserve currency status disappears, not in theory, but in brutal reality. When Britain abandoned gold in 1931, the pound lost 25% of its value within weeks. For ordinary British citizens, this meant their savings, held in sterling bank accounts, lost a quarter of their purchasing power almost overnight. But the real devastation came afterward. Interest rates on British government debt spiked from 4.5% to over 8%. This meant savage austerity, cuts to pensions, education, and public services. Unemployment hit 22%. Wages were slashed. The government fell. Political extremism surged. The British Empire survived, but it entered terminal decline. By 1945, Britain was bankrupt and dependent on American loans. The empire dissolved over the next 2 decades, 15 years from superpower to second-rate economy. Now imagine that scenario in a hyper-connected, digitized, globalized world where $7 trillion can evaporate from pension funds in a single trading session. The dollar losing reserve status will not just mean inflation and unemployment. It means your retirement account losing 40 to 60% of its value permanently. It means basic imports becoming unaffordable, as the United States imports $3.8 trillion annually. It means Social Security and Medicare becoming unsustainable because they are funded by deficit spending. It means state and local governments going bankrupt as their bonds collapse. It means geopolitical retreat as military spending becomes unaffordable. It means domestic political collapse as populations demand solutions nobody can provide. This is not fear-mongering. This is math. A reserve currency nation running trillion-dollar deficits can only exist while the world needs that currency. When it does not, the music stops and there are no chairs. Here is what infuriates me most. We are watching this happen in real time, and the mainstream narrative is still that everything is fine. The Federal Reserve keeps insisting inflation is transitory, even as prices remain permanently elevated. Treasury officials keep saying foreign demand for U.S. debt is strong, even as China liquidates. Financial media keeps calling market volatility healthy corrections, even as Treasury yields spike to crisis levels. This is the same denial Britain exhibited in 1931, the same refusal to acknowledge reality until reality forced itself upon them. And the worst part is this: the institutions that should be preparing you for what is coming, the financial advisors, the banks, the government agencies, cannot tell you the truth, because the truth would trigger the very panic they are trying to prevent. So they maintain the lie. They keep you invested in dollars and dollar-denominated assets. They keep you trusting the system right up until the moment it fails, just like they did in Britain, just like they did in 2008, just like they are doing right now. This is malicious competence. They know what is coming, and they are protecting themselves while leaving you exposed. You have a choice right now that most people will not realize they had until it is too late. You can dismiss this as conspiracy theory. You can trust that somehow this time will be different. You can believe that the most indebted government in human history, running the most overvalued currency in modern finance, will somehow avoid the same fate as every reserve currency before it. Or you can learn from history. You can recognize that China's $53 billion treasury sale is not an isolated event. It is a signal. You can understand that the mechanism that destroyed Britain in 1931 is being deployed right now with artificial intelligence level precision and blockchain level speed. You can prepare, not by panicking, not by hoarding canned goods and ammunition, but by diversifying out of dollar-denominated paper assets, by understanding that when currency confidence collapses, tangible assets such as productive land, physical commodities, skills, and community relationships become the only real wealth. So here is what I need you to do right now. If this video made you question even one assumption about the stability of the current system, hit the like button. If you think more people need to understand what is coming, share this video. The algorithm suppresses content like this precisely because it threatens the illusion of stability. And if you want to keep receiving this unfiltered analysis, the kind that connects historical patterns to modern crises, before mainstream media admits there is a crisis, subscribe and turn on notifications. Drop a comment right now. Are we wiser now, or are we just walking the same path to collapse in better suits? Because here's my final warning. In 1931, Britain had the luxury of a slow collapse and a successor empire ready to catch the system. In 2025, we have neither. The fall will be faster, harder, and global, and the clock is already ticking.